This is Scott Becker with the Becker Private Equity and Business Podcast. We're thrilled today to be joined by one of our most listened to guests, Matt Wolf from RSM, the most remarkable sort of mid-market private equity consulting firm. Uh, Matt's going to talk today about what's on everybody's mind, tariffs, and a lot more. Matt, we're at a spot where deal activity just seemed to be picking up. Now we've got a little bit of a fly in the ointment, so to speak. This tariff thing is going bananas. What do we make of this? What does it mean for the deal market, for the 10-year, for inflation, and a lot more?
Yeah, great questions and ones we're talking about hourly, right? I mean, and I will say, like, I am no sort of policy expert by any stretch of the imagination. Maybe they're good, maybe they're bad in terms of policy. I don't know. All I know, and what the data show, are that it's, creating a lot of uncertainty in deal making and around investment decisions when there is no clarity or very little clarity on the breadth and depth and scope and frankly timing of tariffs. We've had many clients and sponsors take, another look at deals, shelve investment, push things off because they're just waiting for more information. And we're seeing that uncertainty reflected in real time in the 10-year, which has been on an absolute tear. It's an indication of the cost of capital, right? So we have, not only do we have more uncertainty in the sort of overall business investing community and the deal making environment, but the cost of capital is increasing, right? So the cost of making the wrong decision is increasing, and we have sort of these second and third order effects that's really creating a lot of uncertainty and confusion. And again, it's not for me to say whether they'll be good or bad. I don't know, and I'm not going to comment on that. All I know is that it's creating uncertainty, which delays investment and makes it more difficult to get deals done.
I mean, 100%. And whether they're good or bad, again, the markets hate them, inflation hates them. The only people that like them are sort of part of the target that Trump is trying to please, which is manufacturing workers, target workers in some of these swing states where manufacturing in so many places has been shipped overseas. That's who likes them. He sees one stat that factory output is going up and is ignoring a lot of the other consequences. And we'll see how far he pushes this. At some point, the rest of the American public is going to cry uncle. But at some point, until he starts to hear that and doesn't and sees such disastrous results in other places, it seems like he might keep on pushing this. Just fascinating to watch.
Absolutely. And I think the other thing that perhaps those in the administration maybe take for granted is just the lead time on making these investment decisions. And to your points, maybe some of these defensive tariffs will encourage manufacturers to move operations back to the United States. Maybe, right? But that's a very expensive decision to make that has a lot of variables. A lot needs to be thought through for any sort of executive, any operation, whether it's a farmer or even a consulting professional service, like, whatever, manufacturing, doesn't matter what the business is. It's a very expensive decision, investment to move some centers of production. And without certainty around, well, what do those future tariffs, future costs look like? It's a leap of faith to make some of those investments, and we're not seeing many companies do that.
Well, and that's a fascinating point, because what happens is you have some of these big companies that seem to be trying to make sure they stay close to the president, making some big announcements about plants and building in the United States. But right, if the next president then reduces those tariffs dramatically, then you end up back to a spot where it's so much cheaper to invest overseas. So it's very hard to make business decisions based on what a president does, particularly when he does it without building broad alliance and consensus around it. And he may be right that it's the right thing or the wrong thing. I can't judge that. But what I do know is when there's so much anxiety around them and so much talk around them, it's hard to get to that point where you have certainty and people could bank on these for the longer run to know that this is what's going to be in place. And that's probably more challenging when you don't build consensus on both sides of the aisle, that you get whipsawed as a manufacturer that you go and build things here or start moving production back here. But in 4 years, it becomes a lot cheaper to do it elsewhere. Or even in 2 weeks, if President Trump, negotiates new deals with some of these potential partners, then you're up at a spot where you're starting to take actions, but not only the other side, but our own side is back and forth on these things, and that makes it very hard to do predictable business.
Absolutely, absolutely. Ultimately, the uncertainty, whether it's uncertainty from tariffs, regulatory uncertainty about the path of future interest rates, all of that uncertainty adds to the cost of making business decisions, whether it's where do you want to place a plant, where do you want to hire people, do you want to sell a division, do you want to buy a company? All of that gets made more expensive through this additional uncertainty, regardless of the source. And right now, tariffs are a huge source of uncertainty for most executives, leaders, and investors that we're talking to.
Thank you. And what are you seeing with the treasuries, and what's going on with those, and what should we expect?
Yeah, it's a great question. If I knew exactly the future path of the 10-year, maybe we would be having this conversation on my yacht in the Mediterranean, but I don't. So what we're expecting though is that as this uncertainty will continue to drive yields higher because of the increasing term premium, right? So investors have less certainty about future duration, future policy, future uncertainty in general. So that spread between kind of the natural rate of the 10-year and the traded observed rate will continue to widen, and it'll continue to increase. We're watching sort of some of well, depending on the analysts and the banks you want to read and look at, that sort of upper limit of 477, 48, somewhere 475 around there is kind of, depending again on who you want to listen to, who you want to read, is sort of the upper bound, the marker. Past that could potentially be real trouble for the overall broad U.S. economy. Again, that sort of 4.7 to 4.8, depending on who you want to listen to. And if I just pull up my Bloomberg right now, we're well below that at about a 4.28, but it's come up significantly, 10 basis points, 12, 13 basis points just over the last few days, given some of this uncertainty around tariffs, at least as of this recording. So, we have room to go before it's troubling, but it's increasing, and this does not bode well for the cost of capital, does not bode well necessarily for deal making.
Well, certainly, as it goes up higher, it makes financing deals more expensive. It also moves more money to treasuries and bonds away from stocks, and it could be small amounts, but they have an impact on the amount of money put in the stock market as well. So it has multiple different impacts as to where people put their capital as well.
And that's just a quick note on that, Scott. That's so important too, as we're thinking about and analyzing any of the macroeconomic data or anecdotes or whatever we're looking at, is that the direct impact is so important to understand, right? But that's really just the table stakes. And you got to think through what is the second, third order effect of this, right? So yeah, you're right. If more money continues to flow into treasuries or more money continues to flow into private credit, what does that do for public markets? What does that do for the attractiveness of IPOs? What does that do for other asset classes? The real money is made on the analysis of those second and third order effects, exactly as you outlined. Such a great point.
No, fascinating to watch. Matt, as always, I want to thank you for joining us on the Becker Private Equity and Business Podcast. You're one of our most listened to guests. We appreciate you joining us so much. Thank you very, very much.
Thank you, Scott.